Hi everyone, it's Nancy Godrad, and I'm gonna spend some time going over chapter 16 for you. The objectives are written on this slide. Basically, we're gonna go over the cost systems used to account for the cost of a product. There are two cost systems depending on the manufacturing environment. One is called job order cost system, which is talked about in this chapter, and the second one is process cost system that we're going to go over in chapter 17. And we will talk also about overhead rate and how to come up with that. Okay, so the first thing is that we want to tell you that this part of the accounting, managerial accounting, is talking about actually cost accounting, meaning that we want to measure how much money we're spending producing the product, and then eventually recording how much money we spent. And the last item is to report it by preparing reports. The reports again is only for management, so they know how much money they spend producing the product, because if we don't know the cost, the accurate cost of the product, we're not able to price it correctly. As I mentioned, there are two basic accounting systems to take care of the cost of a product. One is job order cost system, the other one process cost system. Process cost system is used when the manufacturing environment is producing a mass volume of similar products. Let's think about it as a manufacturing environment such as Coca-Cola. The soda production, every soda can is similar to the other one, and the production goes on continuously. It doesn't stop. So therefore, in order to accumulate how much we spend money producing those cans, since the production is continuous, we have to look at just a specific time period, like a month or a quarter or definitely a year. And because the product goes through different departments, like, the first department might be mixing the ingredients, the second department might be, adding water, or the third department might be, bottling. We're going to keep track of the cost based on each department. And each department is going to show its report as far as how much money they spend during that specific period of time. As I mentioned, we're going to go over process cost system in detail in chapter 17. Chapter 16 talks about an environment, a manufacturing environment, that every job is different from the other. Think about a construction company. Every custom home, for example, that they make is different from the other one. Therefore, they will keep track of the cost of the product by the job, not by a set period of time. So each job will have its own record to show how much they spend on direct material, direct labor, and overhead. And what we're going to do is that as raw material moves from being raw material and worked by labor and machinery and becomes work in process, as an accountant, we're also going to move the cost the same way that the product moves physically throughout the process. We're going to move the costs through this process as well. So first, the costs are cost of raw materials, labor, and overhead, and then they become cost of work in process. Eventually, work in process will finish, and it becomes finished goods inventory. And once we sell the finished goods inventory, then the asset will go away and an expense called cost of goods sold is created. So this slide will show you the flow of the cost under a job order cost system. The manufacturing cost, as we learned in previous chapter, includes raw material, factory labor, and manufacturing overhead. We're going to keep track of these costs in 3 separate accounts, so they have their own account. Even though we put them in here in one T account, actually they have their own T account for each one of those costs. Once the raw material, with the help of labor and overhead, becomes work in process, then that raw material is going to be called work in process inventory, which is an asset. Same as raw material. Raw material is an asset, whereas factory labor and manufacturing overhead are expenses. When work in process inventory is completed, in this case, they're making a fire engine, fire truck, so it will become, instead of work in process, it will move from the work in process inventory asset into finished goods inventory asset. And once we sell that truck, then the cost goes from finished goods inventory to cost of goods sold account. Now, we first gonna go over the journal entries when we purchase inventory for the company, and when we use it, when we pay for labor, and when we pay for manufacturing overhead costs. So these are called accumulating manufacturing costs, where basically we're gonna add up all the raw material cost and manufacturing overhead and labor. So we're using an example for Wallace Company. They used material 2000 batteries at $5 and electronic modules at $40. So in total, they spent $42,000 and they haven't paid for it yet. So therefore, we're going to debit this new account, raw materials inventory, which is an asset, a current asset, and we're going to credit accounts payable. Now, once we want to pay for our labor, the cost of labor actually includes a few different costs. First of all, it's their gross earnings. Let's say you pay your employees $20 an hour. That's their gross earning. On the top of that, the employer has to pay out of its own funds money to cover the payroll taxes. What are those? Payroll tax is, for example, Social Security tax and Medicare tax that the company has to pay for employing the factory labor. And also for unemployment. And the fringe benefits are anything such as sick pay, vacation pay that the company pays for having those employees. So therefore, the factory labor cost includes a couple of different components. So in this example, the company Wallace incurs $32,000 of factory labor. Out of it, $27,000 relates to wages. That's what we're going to pay our employee. That's their net pay. And then the $5,000 is the payroll tax that they have to turn around and give it to the government for Social Security, Medicare, unemployment. So in this case, we're going to debit a new account called factory labor, which is an expense. And then since we haven't paid the wages yet, we're going to credit factory wages payable and employer payroll taxes payable, two liabilities. Now, if this was the day that we had to pay factory labor, then instead of factory wages payable, we would have credited cash. Now, manufacturing overhead. Remember what manufacturing overhead consists of? It consists of any cost that is factory cost beside direct material and direct labor. So it is property tax related to factory, depreciation on equipment and machinery of factory, insurance for factory, repairs for the factory equipment, and so everything related to factory, it's going to go into an account called manufacturing overhead, which is an expense. So in this case, Wallace Company has in total manufacturing overhead of $13,800. Consists of what? Consists of the utilities for the factory that they haven't paid yet, so that's why they credited utilities payable, and it consists of the insurance policy on factory, and since the insurance policy already was paid up front, we created an asset called prepaid insurance, and today we're expensing it because that insurance policy, a portion of it has expired for the month, and also includes in manufacturing overhead repairs of $2,600 that in this case they haven't paid for it yet, so that's why they credited accounts payable, and accumulated depreciation. So remember, depreciation is a process that you are allocating the cost of a property, plant, and equipment over its useful life. Therefore, in the past, in financial accounting, we debited depreciation expense and credited accumulated depreciation, this contra asset. Now, in manufacturing, taking care of the accounting for the manufacturing cost, instead of debiting depreciation expense, we're going to debit this new cost called manufacturing overhead. Accumulated depreciation is credited. We cannot credit the asset directly, such as the equipment or the machinery, because of the cost principle. Cost principle indicated that the cost of the asset must always remain at the price that we paid for it. So you cannot reduce the cost until you sell the asset. And the last manufacturing overhead for this company is related to property tax that they have to pay to government. So after accumulating all these costs in their own account, raw materials, work in process, and manufacturing overhead and factory labor, now we're going to move the cost from raw material, factory labor, and manufacturing overhead into working process. Why? Because raw materials has changed its shape, and with the help of factory labor and overhead, now it's becoming something that is not finished product, but it's not raw material. Think about it as the factory producing bicycles. When we have raw material, it's considered to be the tires and the handles. Work in process could be, assembling the tires and handles, but missing the seat for the bicycle. So in order to assign manufacturing cost to work in process is going to get debited, and the three costs, raw material, inventory, factory labor, and manufacturing overhead, will be credited. So we're moving cost from the three accounts, raw material, factory labor, manufacturing overhead, to a new account, work in process. Work in process inventory is an asset. In the next video, I'm going to talk about assigning manufacturing cost to work in process in more detail. So, and then eventually we're going to go over a complete example. Talk to you soon in the next video.